To a special episode on kicking off earnings season. I can't believe we are at the point of kicking off another earnings season. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we are taking a break from our October summit, which is focused on navigating changes in market trends, focusing on option strategies and technical analysis to be skill sets that are required to navigate markets when trends change. But like I said, we're taking a break from that topic to kick off earnings season because earnings season's in earnest kicked off this morning with some early reports from some of the big names in the S&P 500. Tomorrow, we're going to get a slew of banks that's going to give us an early sense for this earnings season. And next week is really when things get really exciting. So what we want to cover here during this session is a preview of the upcoming season, what we saw last season, changes that we expect to see, what we want to focus on from a sector perspective, and then drilling down into some specific examples to give you an idea of how to navigate earnings during this time of volatility that can be both, in many ways, concerning for investors, but at the same time provide the volatility and the opportunities that come with earnings season and how to take advantage of those opportunities using options. Just a reminder, here at OptionsPlay, the education sessions that we host every single Thursday that Jessica and I host is focused on empowering you to trade sustainably and confidently, giving you the skills, giving you the knowledge that you need in order to grow your account in the long run. This earnings season episode is very important as part of that because earnings season, these 4 to 5 weeks are very important in the particular quarter. A lot of changes, a lot of volatility. In order to navigate that volatility, we use options. So we want to talk through how do you want to analyze the upcoming earnings season and how to use options to navigate the volatility. But before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that I'll be using as example purposes during today's session. So we'll kick off with an earnings preview of what we expect for this quarter. We'll take a look at the best and worst sectors that are screening for this upcoming season so that you can get a sense for where you might want to focus your attention. I'm going to walk you through our earnings calendar. This is going to be your roadmap for earnings season, especially if you're trading options. You must use an earnings calendar like ours to help you sort through the hundreds of stocks that might be reporting on a single day, which handful of stocks you really want to focus your attention on. Then I want to walk you through my process for earnings research. When I trade an idea, what do I look for? Opportunities, because within the handful of opportunities, there might be only 2 or 3 that you really want to trade. What are things that I look for before I pull the trigger on an earnings trade with some live examples? And then at the very end, we'll talk about the optimal option strategies that you would want to take once you've identified an opportunity going into the earnings season. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can I trade earnings season with confidence and maximize your returns using options. Now, I see that many of you have already chimed in the chat window saying hello and where you are from. If you are joining us for the first time here at OptionsPlay, please feel free to chime in. Tell us where you're joining from. I'm seeing people joining from all over the world, from South Africa to Mexico to Copenhagen and the Dominican Republic, and obviously many of you here in North America. So just a reminder, if you're joining us for the first time and you want access to the recording and the slides, you can do so by signing up for your free trial at optionsplay.com/sign up, which we posted a link into the chat window, or you can just point your phone to the QR code on your screen. That will get you access to both the recording and the slides, as well as all the tools that I'll be showing you during today's session, including that earnings calendar. Our earnings calendar is specifically designed for options traders, helping you identify the opportunities for options trading. So if you want access to it, you just simply sign up for a free 30-day trial by pointing your phone to that QR code or clicking on the link into the chat window that Philip just dropped. So let's talk a little bit about what we saw during Q2 and what our expectations are for Q3. So in Q2, we did see EPS decline by nearly 6%. When we started off the season, we were expecting about EPS decline of about 7.1%. So actual EPS came in a little better than expected. Revenue did come in relatively flat. Revenue grew at about 0.6%. So last quarter wasn't a particularly great quarter from an earnings perspective for the S&P to contract in earnings by about 5%. Margins also declined as well, down to 11.1%. Some of that earnings growth came down to that margin decline, effectively lowering costs in order to manufacture some profits. So margins came in at about 11.1% versus 11.6% that we were expected at the beginning of the quarter. As far as sectors, technology and discretionary were the two leading sectors. 86% of technology and discretionary stocks beat on earnings. The worst performing sector, utilities. 57% of utility stocks missed their earnings guidance for Q2 of 2023. So Q2 wasn't a particularly great quarter, and probably the most surprising thing, probably the thing that really we really had to pay attention to was the reaction that the market had to beats and misses. And this was really one of the quarters where expectations were pretty high going into it. We had that strong AI rally going into Q2 earnings, so that even stocks that beat on earnings declined by 0.1%. They were largely flat. Stocks that beat did not see moves higher. Stocks that missed, unfortunately, saw about a 2% move on average to the downside. So this is something that is important to pay attention to as to how markets are reacting to beats and misses, because arguably that's more important than the actual beats or misses themselves, how the markets react to the news. So right now, I would say expectations are fairly high for Q3. We were expecting about a 7% EPS decline last quarter. That has changed to roughly only 1%. Actually a 1% EPS gain that's expected for this quarter. So this is kind of a pretty big shift here in terms of expectations for Q3. We've reached kind of the trough here in terms of earnings. We're back into growth mode in terms of earnings. We'll see if the S&P delivers on that. My expectation is that we will likely exceed that 1%, probably somewhere around the 3 to 4% EPS gain here for Q3. That's going to likely drive some upside here, or at least some surprise to the upside that we'll see here for Q3. But it's very early in the season, and between today and tomorrow, we'll have a much better reading as to how stocks perform. But this morning, Delta underperformed here, but we did see stocks like Walgreens, Fastenal actually performed quite well. Fastenal about 8%, Walgreens up about 6% today. So, we have some of these discretionary stocks reporting that are showing some pretty nice gains here to the upside. That's likely what's going to drive the surprise to the upside on the EPS side, and revenue is also expected to grow about 1.5%. So a bit of a shift here in terms of earnings this particular quarter. Right now, sectors that are expected to perform well, we're seeing the highest revision ratios in real estate and technology. I would say probably the one to really look out for is real estate. We've seen a substantial fall off in this particular sector. If you look at a chart of XLRE, it looks ugly. And perhaps that's why you're seeing the best revisions ratios here in real estate. The expectation so far is just so low here for real estate that I think that when you see, how much the sector's underperformed, the bar is set so low that even small beats we'll likely see some significant moves to the upside in real estate. So while technology is one that I think most people have their eyes on, real estate is one that we do not have eyes on. So I think it's important to pay attention to here for real estate. In terms of worst revision ratios, energy and materials. So what we had is the worst performing sector have the best revisions ratio, and the best performing sector, energy, having the worst revisions ratios. So another one to pay attention to, energy. Potentially some downside opportunities here in energy. Oil prices, you have obviously rallied quite a bit here over the past few months. We've seen a pretty significant move to the downside in oil over the past couple of weeks. So likely, I think that's going to have an impact, especially on outlook for Q4 or fiscal year 2023. And I think that's really what is potentially going to drive some weakness here in energy. Materials, also another sector not on most people's radars, just because most of the names within materials are not household names. You generally aren't trading them the same way you are with Apple or Tesla. But materials and energy are the two sectors screening for the worst revisions ratios. That's where you tend to have more downside opportunities versus upside in real estate and tech. And then when we look at the macro data in Q3, the earnings, the economic data has continued to surprise to the upside in Q3, and that's what's likely going to lead to a decent earnings season from a corporate profits perspective. Consumer spending has continued to surprise to the upside, remain fairly resilient. The selective consumer is still out there spending. And that's likely why I believe we're going to likely see an EPS gain that's going to be a little bit higher than the 1% that analysts are currently expecting here right now. Now, we don't have a lot of early reports, but for the few that have reported, 76% of early reports have beat on EPS. That's slightly better than average, but only 67% have beat on revenue, which is slightly below average right now. But again, very, very early in the season, not enough data, in my opinion, to really point towards expectations. Another metric that I think is too early to sell because it's just a small sample size, beats actually underperformed by 1% and misses actually outperformed by 2.5%. But like I said, that's based on such a small sample size. I'm not going to put too much weight behind those numbers just yet. We'll take a look at those numbers again next week. By that time, we'll have a lot more data points to take a look at. That's going to be more meaningful to give us an understanding as to whether or not or rather how stocks are reacting to beats and misses. Okay, so that's kind of a bit of a preview here for Q2 and for Q3. In terms of best sectors, like I said, real estate and technology are the two sectors that we have the highest upward revisions in terms of both sales and EPS. So real estate, technology, and discretionary are the three to look out for in terms of opportunities to the upside. I think technology and discretionary are largely on most investors' minds at the moment, especially stocks that you're probably watching mostly fall under these two categories. But real estate is probably the one that's not so much on your radar. And I think that is the one to pay attention to for this quarter. Downward revisions, communications is probably the communications and energy, I would say, are probably the two that are outliers for me, because communications and energy are the two best performing sectors here right now in Q3. So the fact that those are the best performing sectors seeing some large downward revisions, that means that there are some risks of pullbacks in those sectors. Materials there as well, but like I said, many of you don't necessarily trade material stocks. Energy and communication stocks tend to be more, at least brands that you are familiar with, that you have, some, exposure to either in your portfolio or, in the real world. So in terms of opportunities, that's where I would look for this upcoming earnings season. So how do you find opportunities for earnings season? It really comes down to the OptionsPlay earnings calendar. And our earnings calendar is specifically built for options traders. What do I mean by that? As you can see on any given day, if we look at October 17th, which is arguably a light day for earnings, there is still, in this particular case, 24 stocks that report earnings on that day. of which the vast majority of them, the vast majority of them are not particularly liquid. So our earnings calendar is simply sorted based on options liquidity. The symbols that are in green are the ones that are most liquid. Those are with a score of 1, the most liquid option symbols. The ones with 2 are the somewhat liquid symbols, and the ones with 3 are the ones that are not liquid at all. So when I'm trading options, I focus my attention on only the green ones for the most part. Until we get to the very end of earnings season and things are really light, that's when I sort of sometimes will take a look at the ones in yellow. But for the most part, over the next 3 weeks, 4 weeks, I pretty much only look at the ones that are in green. And as you can see, on a day like October 24th, there are probably 300-400 symbols that are reporting on that day. But I'm only looking at a handful of about 26, 27 stocks on that given day, because those are the ones that are most liquid. If you're trading options, you need, especially around earnings season, you must trade very liquid symbols. If you're trading stuff that's not very liquid, you might have a tough time during volatile days to be able to get out, especially if a trade's not going the direction you expected to, and you're trying to get out the day after a poor earnings result comes out or the stock makes a big move and you can't get out. That's going to be a problem. So earnings calendar, from my perspective, should be sorted based on liquidity first. That's how you do your research. And then within the stocks that are reporting on a given day that are liquid, as you can see, some names have an asterisk sign, the ones at the top of the list. The ones that are asterisk sign means that these are the ones that report before the market open. So if we look at these list of names on the 18th, the ones that I've highlighted, those are the ones that report in the mornings, and the ones that do not have the asterisk sign, those are the ones that report in the afternoon on that given day. So you know whether I need to open that position before, the previous day or the day of, in order to capture that earnings season. This earnings calendar is going to be your roadmap if you are trading earnings trading options for earnings. So looking at tomorrow, you have JP Morgan, you have BlackRock, you have Citigroup, you have Wells Fargo, you have United Health. Those are the pretty big names that I think we're paying attention to here for tomorrow. That's going to give us a read into the banks, how they're navigating this rising interest rate environment, what their loan provisions are, expectations in terms of outlook for, how credit is continuing to evolve in this market of rapidly rising interest rates. Are they seeing rising delinquencies? These are things that are going to give us a good read on the economy. We have Delta, we have Walgreens that reported earlier today. And next week, we start to get into some of the more consumer-based names, as well as some technology names. We have Tesla reporting next week. You have some of the exchanges, but largely next week is still going to be mostly finance type stocks that are reporting next week. But Taiwan Semiconductors, AT&T, Philip Morris. So you start to get some of those consumer names starting to report next week. But this is really the tool that helps you understand going into next week what you want to pay attention to. From my perspective, if I'm looking at this, Goldman Sachs is interesting to me. Johnson & Johnson is interesting to me. Netflix and Tesla, obviously, I think are interesting for most people. Procter & Gamble, giving us a good sense for consumer discretionary. Morgan Stanley from a finance perspective. Freeport-McMoRan on the commodity side, AT&T, Philip Morris, Taiwan Semiconductors, Intuitive Surgical in terms of healthcare, and American Express. Those are probably the big ones that I'll be paying attention to here for next week. And this calendar makes it really easy for me to navigate the few hundred symbols that are reporting next week, which handful of stocks that I want to focus my attention on with regards to trading earnings. Now, for those of you asking, where do I access the earnings calendar in your OptionsPlay tool? You can just click on the hamburger menu on the upper right-hand corner. And when you click on it, you can click on earnings, which will take you to the earnings calendar. That will get you to the earnings calendar. That is your navigator for the upcoming earnings season. And that will take you to a page that looks like this, which has the earnings calendar embedded into the page. So green cells are the most liquid symbols. Yellow cells are somewhat liquid, and anything that's not colored are stocks that you generally want to stay away with going into earnings season. Okay. Any questions with regards to the earnings calendar? Okay, let's move on. I want to walk you through the thought process that I have with every single earnings trade that I make, because this will help you create a process for yourself if you're thinking about trading earnings. If you have traded earnings before, I'm sure you understand how much volatility is around this type of these types of trades. If you haven't traded earnings before, hopefully this gives you some insights into what you're looking for going into earnings season. So I was looking at JPM earlier this week, and first of all, from a technical perspective, you have a stock that has been has been trending lower here. That over just the past couple of days, as you can see, the 1 month trend has started to turn positive. Very early days, potentially the sign of a reversal higher here. But what we're looking for is whether or not this has the potential going into earnings season to outperform. So you have a chart that starts to show some early signs of a trend starting to improve. Very early signs, but certainly showing some of those signs. You've got the breakout above that trend line. You've got trends starting to turn a little positive here. I am pretty early in this particular trade, but given the fact that it reports earnings later this week, I have to enter this trade in order to get into that. For those of you that follow our daily play, or for those of you that are members and subscribers, you get trading signals from us. This is one of our trades from earlier this week, is to get into an earnings play here for JPM. And over the next 3 to 4 weeks, you're going to see a lot of earnings plays that we're going to trade in our portfolio. So the first thing I look for is just the underlying chart to see if we're having any supporting evidence of a potential move in one direction or another. And the early trends show us that maybe this is on track to see some moves here to the upside. But more importantly than looking at the absolute chart from my perspective going into earnings season is the relative chart. So if you look at the relative chart of JP Morgan relative to its sector, what you see here is, despite the fact that you've seen that pullback here in the chart, compared to its sector, it actually continues to outperform. So that's one of the things you have to look at, because it's pulling back along with the market, but it's actually pulling back slower than the rest of the market. What that means is that there's accumulation. People are selling other financial stocks and accumulating JPM, even though it's falling along with the market. It's not falling as fast as the market. It's not falling as fast as the sector. So it's outperforming the sector. And that's kind of what I typically like to look for going into a bullish earnings cycle, is that you want to see accumulation going into an earnings season. You don't want to see people distributing. You don't want to see a stock underperforming the sector going into an earnings season. You want to see people accumulating that going into earnings, the earnings event. That gives you a higher degree of confidence that there is going to be a beat, or at least that the stock will react positively to the news. Nothing is surefire, nothing is guaranteed, but these are the things that I look for going into a news announcement that can give us some clues of a potential outperformance going into the earnings event. So the absolute chart is the first thing you look at. The relative chart also gives you more information to decide whether this is a trade that you want to make. So we took a long position going to JPM. There are some other fundamental factors that we had to consider, but when you look at valuation and profitability, this is really where JP Morgan excels. And in terms of the banks, this is certainly best of breed with regard to the banks. They have a position, they have a revenue position that looks quite strong here. They're looking at about another 10, 12% of revenue growth. They're looking at another about close to 20% in terms of EPS growth for this year. So what you're looking for are stocks that are trading at below average valuation with faster than average EPS growth when possible, when you're looking at bullish opportunities like I'm looking here at JP Morgan. JP Morgan's trading at about 12 times forward earnings, which is a little bit lower than its long-term average, about 15 times. And this quarter is meant to be a fairly strong quarter in terms of both revenue and EPS growth. So you have what looks like lower than usual valuations, and that kind of goes with the current market environment that we're in. But at the same time, because of how fast interest rates have risen, JP Morgan certainly stands to benefit from that rise in interest rates, which is why we expect to see revenue so strong here for Q3. So when you combine all of those three things together and the fact that JP Morgan is hugely profitable, those are the things that I typically look for going into an earnings season. Now, if let's say you are bearish on a trade, that you wanted to look for somewhat of the opposite, stocks that are trading at relatively rich valuations with relatively low EPS growth. A good example of that, for example, the two positions that we have right now, for example, Microsoft. Microsoft trading at about 28 times forward earnings, but expecting EPS growth at about 11%. So we're talking about EPS growth that's even slower than JP Morgan, yet trading at a valuation that's nearly triple the valuation of what JP Morgan's are trading at. Obviously, very different companies. Can't compare those apples to apples, but just to give you some figures to think about, this is Microsoft, for example, is expecting what is slightly below average growth for the tech sector, yet it's trading at the higher end of the range from a valuation perspective. Many of you can argue as to why it should trade at a higher valuation, but when you think about it, when you boil it down to the fact that you own a company because you want to invest in its future profits, if those future profits are not growing substantially fast enough, you're going to likely reallocate those resources or your capital to stocks that are growing much faster at lower valuations. So when you factor those things into play, those are the things that I typically look for, whether I'm looking for a bullish or bearish opportunity going into earnings season. And then when you look at trading strategies, right? So once you've identified an opportunity, you've identified a stock that you like, you see that it's performing well relative to its sector, you like the technicals or you like the fundamentals from a valuation perspective, how do you actually trade that trade using options? And that's really kind of where we use typically a 3-by-1 debit spread. This is a variation of the typical 2-to-1 debit spread that we use for trading a regular directional move. But when it comes to options and you have a strong directional move, we typically make some modifications to this where we trade what's called a 3-by-1 debit spread. And 3-by-1 means that you're roughly getting about a 3-to-1 risk to reward ratio on the debit spread. So the structure of debit spread like this, you usually go out somewhere between 45 days to 60 days in terms of expiration. And what you're doing is you're buying an out of the money call or a put. Because we're bullish here, we're buying call options. You're buying about a 40 delta call option, so a slightly out of the money call option. And against that, you're going to sell about a 16 delta call or put against that. So for JP Morgan, at the time when I put together these slides, it was trading around 146. We were going to buy the 150, 160 call spread. So I'm buying a call spread that's out of the money. I'm buying the 150, selling the 160 call spread. And as you can see, that's the $10 wide debit spread that I'm paying $2.47 for. So I'm paying about a quarter of the vertical width, and that gives me my 3-to-1 risk to reward ratio. I can potentially make a max reward of $753 in exchange for my risk of $247. That's about a 3-to-1 risk to reward ratio. And you can generally only achieve that by trading debit spreads that are where the long leg is out of the money. You can't do it when the long leg is in the money, which is typically our default debit spread that we go to. When you use the in the money spread, you usually get about a 2-to-1 risk to reward ratio. But for earnings season, because our expectations are for a big move in one direction or another, and we're trying to capture that big move, and at the same time, there's a high likelihood or a higher likelihood that during earnings season that you get a quick move and you kind of see the trade go against you very quickly. You want to be able to limit your losses to as small as possible when the trade doesn't go in your favor, and you want to expand your potential profits as much as possible when the trade does go in your favor. So the 3-to-1 risk reward ratio debit spread really allows you to do that. And this is the only time that we use this specific variation of a debit spread is around earnings season, when we have a strong directional view and we think the stock can potentially make a big move in a very short amount of time. That is the time to use these types of 3-to-1 risk to reward ratio debit spreads, because you're able to capture that potential 3-time upside while limiting your downside to as small as possible. So risking $250 on a $146 stock means that I'm risking 1.7% of the stock's value to trade this debit spread. That's about as low as you can possibly get it with regards to risking less than 2% of the stock's value on a single contract of a debit spread, so that even if the spread loses 70% of its value because it's not going in your favor, that equates to a 1% of the stock's value that you're risking. And if the trade does go in your favor, you have upwards of 3-to-1 risk to reward ratio. And earnings season is really the only time that it makes sense to use this type of strategy. Now, here's the thing. For different scenarios, you're going to have different viewpoints. In some stocks, you're going to believe that the stock is going to have a possibility of making a big move in a short amount of time. Usually these are stocks that are more volatile. Usually these are stocks that have either been beaten up so much, like Walgreens, and you get that 7% move in one day, or stocks that have rallied so much that kind of are at risk that if it misses, that you see that big move to the downside. So those are the times when you want to use this 3-by-1 debit spread. But there are also other times where your view is a bit more milder, especially if you think about blue chip names. If you think about names that typically don't move a lot on earnings, think Coca-Cola, think Pepsi, think AT&T, these types of names, they don't move a lot on earnings. Well, that's really where you can then consider selling a credit spread instead of buying a debit spread. Debit spreads are for when you expect that big fast move in just a short amount of time. Credit spreads are for when you expect the move to be more mild, or perhaps you expect the stock not to make any moves on earnings. Then selling credit spreads makes sense for you. So those are the two types of option strategies that you might trade around earnings. When you're selling credit spreads, the rule of thumb is to go out roughly 45 days to expiration. And what you're trying to do is you want to sell an at-the-money call or put, and then buy back the 25 delta call or put against that. Now, you don't actually have to do that work yourself. OptionsPlay automates that tool that for you using the implied volatility button here on the trading tab. I'll show you that in 1 second. But the rule of thumb is that you must collect 1/3 of the vertical width here in order to sell a credit spread. And one of the reasons that we didn't sell a credit spread on JP Morgan for our trade is because if you look at this credit spread, if I sold the 146, 139 put spread, I'm collecting in this particular case only $2.15. Now, this is a $7 wide credit spread. So $2.15 divided by $7, you can see I'm only collecting 30% of the vertical width. So in this particular case, it doesn't make sense to sell a credit spread because I'm simply not collecting enough credit. And that's why in this particular case, I chose to trade the debit spread here for JP Morgan. But those are the two types of trades that you can potentially make, but just make sure you understand how to structure this and what to generally look for. I will leave these slides for you so that you can review these when you're placing this trade and use this as your cheat sheet in terms of structuring the trade and what you need to look for. The debit should really ideally be around 25% of the vertical width. So on a $10 wide debit spread, you want to pay roughly a quarter of that. So $2.50, which is roughly what this debit spread is trading for right now. And then on the credit spread, you must collect 1/3 of the vertical width. On a $7 wide credit spread, that's going to be a little under $2.50. Here, you're only collecting $2.15, which is not enough credit. So this is one that I actually would personally pass on if, let's say, I couldn't find the right structure that makes sense for me. So remember, when you trade options, not only do you have to find a stock that you like, you also have to be able to find an option strategy that makes sense. And if all of those things don't align, you should not place the trade. And I can't tell you, sometimes you do a lot of research on the underlying stock and you say, great, this looks like a fantastic setup. The stock is doing well. It's outperforming its sector. I think that from a fundamental perspective, it makes sense. And then you go look at options and it just doesn't make sense. The best thing to do at that point is to simply move on. Find another stock where you agree with the technicals, the fundamentals, and you can find an options trade that makes sense. Because if you do all of that work and then you trade a suboptimal option strategy, then you could potentially be, risking more money than you should on that particular trade. And that's something you should never, ever do. So always be disciplined in your approach when it comes to earnings. because things move fast during earnings season. You have to be able to make decisions quickly, and you have to be able to be positioned correctly when the stock does make a move in the direction you expect it to. And more importantly, when the stock doesn't move in the direction you expect it to, you better be positioned correctly to minimize that risk, which is why the best practices that we're laying out here during this webinar is designed to help you understand my process. Now, you don't have to follow my process exactly, but you should follow some kind of practice that involves looking at the chart, looking at the business or the fundamentals, and making sure that the option strategy you trade it makes sense and has built and follows all the best practices for those options trades. Because if there's one time that you need that the most, it's around earnings season. You're putting on a lot of capital at risk over a very short amount of time. You must follow these best practices to ensure that you have a higher degree of success at the end of earnings season. So that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of navigating the earnings season. Like I said, during the October Trading Summit, Jessica's walking you through navigating market changes. Last week, you learned about an introduction to technical analysis. Next week, you're going to learn about cover calls and poor man's cover calls. And the week after, you're going to learn about hedging with options. So I hope that you'll be able to join Jessica for those 2 sessions. And just a reminder, if you want access to the earnings calendar, you want access to the slides from today, simply either you are a member and you'll receive it, or if you don't currently have a free trial, sign up using the link here on your screen. Go to optionsplay.com/sign up or point your phone to that QR code on your screen in order to sign up for your free trial. That will get you access to the earnings calendar, the OptionsPlay tool, as well as the recording from today's session. So with that, let's open this up for Q&A. This was a quick and fast session. This was meant to just give you the reminder of what you need to navigate the earnings season. So let's point ourselves to the Q&A section. There's a Q&A window and a chat window at the bottom of your screen. If you can type your questions in the Q&A window, I'll try to answer as many questions as possible. Gordon's asking, what do you mean by discretionary sector? That's consumer discretionary. That's a specific sector, names like Nike, Starbucks, Amazon, Home Depot. Those are the names in the consumer discretionary sector. Lululemon, those are the big drivers of consumer discretionary. So stocks that are not consumer staples. Consumer staples are like Pepsi, Coca-Cola, Procter and Gamble, stuff that you need at all times regardless, versus consumer discretionary is for discretionary spending. Yes, we also have an earnings calendar for TMX as well. So yes, there's both a calendar for US and Canada. I pretty much only sell options, but I always stay away from earnings date. Are there any specific strategies you use when buying or selling options around an earnings date? So Mark, I think you asked that question perhaps before I covered the debit spread and credit spreads. But if you prefer option selling, then sell credit spreads. Just make sure that if you're selling a credit spread going into earnings, you follow this rule. If you don't follow this rule, you're going to end up taking on more risk around earnings than you really need to be taking. So make sure you follow this rule. So for example, JP Morgan, if let's say I did all my research on the underlying stock, I like the stock, I think it's going to move higher on earnings, but when I came around to finding this credit spread, I couldn't find an optimal credit spread, I have to move on to the next stock. It's just not worth risking the money on JP Morgan when the options trade doesn't make sense. So hopefully that answers your question. Will you show earnings trades you make? Yes, absolutely. JP Morgan is one of the earnings trades that we made for our daily play portfolio, and we'll be doing a lot more during earnings season. You can look back during the last earnings season. We covered a lot of earnings trades last season, so we'll continue to do that as well. Is the earnings calendar compatible with any other tool other than MS Office? I'm not sure what you mean. You don't need MS Office to access the tool, the earnings calendar. The earnings calendar is just a website. As long as you have access to a browser, you'll be able to access it. For credit spreads, would it make sense to use the 40-20 deltas versus the 15-25 at times? You absolutely can. I don't love doing that during earnings season because 40-20 means that you're probably taking on near a 3-to-1 risk reward ratio, meaning you're risking $3 for every $1 you can potentially make. And earnings season's the time when things, black swans kind of happen, right? Or big moves, big unexpected moves happen. And when you trade that 40-20 delta on a credit spread, every time you have one trade that doesn't work out for you, you're wiping out 3 successful trades. It's very hard to have, that requires you to be right more than 75% of the time to be profitable in the long run. I'd say it's pretty hard to have a 75% hit rate during earnings season. So you can, but I don't love doing that. You have to be right all the time in order to be profitable. Are buying double diagonals suitable for earnings? So calendars and diagonals certainly are suitable. Double diagonals, in theory, give you the best of calls and puts. You can think of them similar to kind of like an iron condor. You're getting kind of maximum potential on either side. I'll be honest, I don't trade any double diagonals. I trade some diagonals from time to time from earnings season. But diagonals are more for diagonals, and specifically double diagonals are a volatility trade. So you would have to have a scanner, on kind of the implied volatility of the differences between the two expiration dates. What you're trying to do is you're trying to sell expiration dates that are near dated that have very high volatility, and you're trying to buy longer dated options that have very low volatility. So what you're looking for is the biggest possible difference between in implied volatility between the two expiration dates. So you have to specifically scan for that one criteria for double diagonals to work out well for you. I don't necessarily think earnings on itself is going to be enough, even though earnings season is usually when you get the biggest differential between the short dated option and the long dated option. But you have to scan for stocks where that difference is at an extreme, and that's what you're trying to trade. Sort of deep end of the pool stuff. So it depends on how much experience you have with trading options and the type of tools that you have access to help you scan for those opportunities. How concerned are you with earnings when trading the wheel strategy? Generally speaking, wheel strategy is for long-term investments. The long-term investments, you're not as sensitive to earnings because you're in it for the long run, right? Certainly earnings could be a reason where you'd shift your views on a long-term investment, right? So perhaps a company continues to, not be profitable, even though you think it's going to start to be profitable, and that changes your view. And you say, hey, I thought this was a long-term investment worth making, but clearly it's not really working out. I got to change my strategy. So earnings season is useful from the perspective of the information that you get about the company for the long-term investment. But in terms of the actual movement itself, less so. Earnings season is actually when implied volatility is highest. So that's when you can generate the most yield. So especially selling cover calls during earnings season will generate more yield during that 1 month than the other 2 months of the quarter. Same thing with selling cash secured puts on stocks that you want to purchase. You're going to get the highest yield, the highest discount potentially on that purchase. So, I trade wheel strategy around earnings, but, you have to be mindful of your strike selection during earnings season. What is the earnings day as relate to the days to expiration? I'm not sure I understand that question, Sergio. I'm not sure what you mean by what is the earnings day as relate to the days to expiration. Please, if you don't mind clarifying that'd be great. What day does JPM report? So for any symbol that you use OptionsPlay on, it will tell you when it reports here on the next earnings cycle, right? And we even have within our watch list, in our global watch list, we have a watch list here called high implied volatility earnings. These are all liquid symbols. So what you have is a watch list of all the stocks that are reporting earnings. So Bank of America, if you click on it, it'll show you reports tomorrow morning. BlackRock reports tomorrow morning. So you can kind of see what are upcoming earnings. This covers the next 5 calendar days in terms of earnings. So any of these are kind of high implied volatility liquid symbols that report earnings. Bank of America reports next week. on October 17th and in the AM. So it'll have AM and PM here, so you know whether it reports in the morning or in the afternoon. Opinion on diagonals and calendars for earnings. One strike, weeklies, long and normal, typical tasty. So absolutely, if you have the tools to trade diagonals and calendars, it is a trade that a lot of professionals like to trade, is the difference in volatility between the short and long dated expirations. What determines whether you use the puts or calls in a vertical spread? Your directional view. That's it, right? So for debit spreads, you trade calls if you're bullish, puts if you're bearish, right? You don't mix it up because you certainly don't want to trade a bearish trade when you're bullish on the stock or vice versa. And credit spreads are just the opposite. Puts are bullish, calls are bearish. So your directional view is what determines whether you trade a call or a put. So whether you have a bullish or bearish view determines whether you buy a call or a put. When do you put on the trade in relationship to the earnings date? Generally speaking, I would say I prefer putting on my trades very close to the earnings date. So usually 1 or 2 days at most before the earnings date. Occasionally you will enter a trade up to a week before, but for the most part, you enter it the day before. And you generally don't hold on to them for very long past the earnings date, because at some point after earnings, even if the trade goes in the direction you expected to, you want to make some adjustments to that trade. You want to lock in some profits and then roll that trade, or if a trade's not going in your favor, you definitely want to cut losses immediately. So generally speaking, just a few days before, and I'm sorry, no more than 1 to 2 days before, and generally you don't hold on to it for very long with past earnings without making some form of adjustment or potentially closing the trade. Michael's asking, he's saying that many times he'll hear someone will say, the stock will move X dollars on earnings based on options prices. How is that determined? Great question. So if you look at Bank of America here, it reports earnings on October 17th. What you look at is you're looking at the at-the-money straddle. So here's the at-the-money straddle for November 24th. And what you want to do is you want to look at the at-the-money straddle for the expiration date. So because it expires on October 17th and the closest expiration date to that is October 17th, you can see that the trade cost here is $145. So that's the expected move, is $1.45 on a $26 stock. So $1.45 divided by $26. That means the stock is expected to move about 5.5% on earnings. So that's the expected move of a stock. So it's always calculated based on the at-the-money straddle, and calculating the straddle as a percentage of the stock price, or it's rather a $27 stock closer. So it's a 5.3% expected move for Bank of America. So you use the at-the-money straddle to calculate the expected move. And if you want to be more accurate, you can use the mid price. That's probably a more accurate price for the expected move. On the risk graph tool of an options trade, if I make an adjustment to the position and open and close a leg, will the tool capture the profit or loss during the trade as it goes forward? I'm not sure I understand your question. I think what you're saying is that if you trade a spread and you close one leg, will it capture the profit or loss on the trade after you close out the leg? The shorter answer to your question is no. But I honestly, I'm not 100% sure I understand your question, Peter. So if you don't mind clarifying, I'm happy to try to answer that question. Can you use OptionsPlay on multiple platforms, Schwab, Fidelity, and Merrill? Yes, so we're integrated into Fidelity and Merrill. We're not integrated into Schwab at the moment. We are working on a Schwab integration so that you can see your Schwab account and trade it to your Schwab account. What is the usual IV behavior around earnings before and after? So implied volatility will always run up going into earnings. So right now, so you see Bank of America and implied volatility is around 30%. Expectations after earnings is that it's always going to decline. So I would expect, I usually drag this slider down about halfway down to the lower bound in order uh, to simulate what the implied volatility is going to change between now and expiration, and that's going to give me a more accurate reading of my P&L simulator. So for example, if let's say I sold this straddle, and I'm expecting that, let's say by October, I don't know, 18th, which is the day after earnings, what is my expected return? As you can see, if I look at what if implied volatility stays the same at 30%, it's going to say my return on this is 67%. But if I model the collapse in implied volatility correctly, now it moves up to 74%. The 74% is going to be a more accurate number because implied volatility will always run up going into earnings and it'll always collapse after earnings, what we call implied volatility crush. So, as you can see, it's not night and day, but just to get a slightly more accurate view of what your expected P&L is going to be, you should adjust the volatility lower post an earnings event. I think there's a bunch of questions here in different forms that I think I've already answered in previous questions. I've answered that question here as well. Where do you see the expected move? So you don't see the expected move, you have to calculate the expected move, right? So what you're looking at is any stock. Let's just pull a stock here in the earnings calendar here. Let's look at Netflix here. So Netflix is currently trading at $361. You click on the high implied volatility portion of the trading tab, and that's going to give you the straddle. And what you want to do is you want to find the straddle that closely matches this earnings date, which is October 18th, right? So that's going to be the October 20th expiration. So if you look at the straddle, at the money straddle for the October 20th, it's trading at $31.78. So what you do is you take $31.78 divided by the stock price of $361.20, and what you get is 8.7%, 8.8%. That tells you that's the expected move of Netflix going into the earnings announcement. Another way that you can do this is you can use the trading range simulator. The trading range simulator gives you the expected move in dollar terms of a specific expiration date. So when you use the trading range simulator, you can select the expiration date and it will give you the expected move down to 320 up to 400 with regards to the expected move for that earnings season, for that earnings expiration date. Any other questions? Would you consider doing a straddle? Short straddles, yes. Long straddles, never. Never, ever, ever will I trade a long straddle. You will almost always be guaranteed to lose money in the long run being long straddles. Short straddles, I will occasionally. It is actually one of the best performing strategies in the long run, but it's not particularly recommended for most retail traders because it does have unlimited risk. The risk is not as high as most people think it is, but it truly does have unlimited risk. And it's not something that we generally suggest most people to trade. How often would you exercise options when you work full time? Or are there particular strategies that I should focus learning first? So let me answer your second question first. What are particular strategies you should focus on learning first? Debit and credit spreads. If you want to focus on something first, debit and credit spreads are first. And if you don't know what a debit or credit spread first is, then you have to first learn the basics of a long call and a long put. But those are the foundations that you need to learn. But the ones that you really want to spend mastering are debit and credit spreads. There's no, those are the two strategies that you should focus on. How often would you exercise options? I think more, I think the question is really how often do you trade options when you work full time, not exercise options. Generally speaking, I think trading 2 to 3 times a week is suitable for someone who's working full time. We send out at least 2 to 3 trading signals a week that you can follow along, that you can just take a look at our research and follow along. You don't have to do a lot of your own research, and that's going to help you understand kind of our thought process, our trading process. And as you get more familiar with it, that's when you might want to start doing some of your own research using our platform. That's going to help guide you finding ideas, validating your views on the underlying stock, and then helping you structure the trade. Our platform does all of that for you. I think I've already answered this question about using the 40-20 delta on credit spreads before. Can you demo the use of reduce your risk and take profit buttons in the portfolio? So those are just those are alerts to help you decide when do you need to do something. The reduce your risk alert comes when you are trading anything with unlimited risk, such as a short straddle, and you have truly unlimited risk. It will show you things that you can do to adjust your strategy so that you have limited risk. That's what reduce your risk does. And take profit is simply just you have a trade that's reached a threshold where continuing to hold on to it will yield relatively small gains relative to the amount of the risk that you continue to take. And it's time to potentially consider closing out that trade. So we have alerts on your portfolio that give you, telling you what to do. And those alerts are really designed to give you kind of notifications of what to do, right? So here, I have cover calls found for the most part on my portfolio. I don't have a lot of other types of alerts, but this is designed to help you quickly understand where you want to focus your attention on in your portfolio. You can click on the alerts button and just click on where you have the alerts, and it will sort based on all of your portfolio data which positions you should be paying attention to here for today. All right, I have time for one more question. How do you decide on one daily play trade each day? Is there the best of all stocks or what? No, I mean, every single day there's a handful of stocks that I can potentially look at. It's really a combination of the technicals, the fundamentals, and the option strategy. When I'm looking at all of those things in conjunction with each other, I'm looking for ones that have a good balance across all three. Are you always going to be able to find, quote unquote, the best one? From my perspective, there's no such thing as the best one. You're just looking for ones where you have alignment between the technicals, the fundamentals, and an option strategy that makes sense. And usually I try to do it on names that are household names that you recognize, names that you're familiar with, is really kind of where I prioritize on the daily plays. So with that covers what I have time for here today. I really hope that this was helpful in giving you a better understanding of how to navigate the earnings season. There's a lot of opportunities that's going to come out here in the next 3 to 4 weeks. Hopefully this gives you a roadmap of how to navigate it, and more importantly, where to pay attention to in using the earnings calendar as to how to focus your attention during earnings season on just a handful of stocks on each given day as to where you want to spend your time doing research. With that, thank you so much. Have a great trading week, and I'll see you guys here on Monday for our Monday morning macro outlook session. Thank you so much and have a great trading day.